Shell posted $6.92 billion in adjusted earnings for the first quarter of 2026, and the market's first read was straightforward. Hormuz is closed, Brent is above 110, profits follow. That reading is incomplete, and the incompleteness matters for how long the position holds. The $3 billion buyback and the 5% dividend hike were not announced alongside the earnings as a passive distribution of windfall cash. They were paired as a deliberate signal about management's forward cash confidence at current oil prices. Net debt rose to $52.6 billion from $45.7 billion in the prior quarter, meaning Shell absorbed a $6.9 billion debt increase in the same quarter it committed $3 billion to repurchases. That pairing is the non-obvious read. Management is signaling it views the current earnings environment as durable enough to lever the balance sheet while simultaneously returning capital. The position pressure this creates is directional. Institutions that were underweight Shell on oil price uncertainty moved to close that gap when the buyback confirmed management's own confidence threshold. Who moved first is visible in the share repurchase timing. Shell bought back 1.45 million shares for cancellation at approximately £31.72 on May 15th, 8 days after the earnings release, while retail positioning data for the same window is not yet in the public record. Institutional repositioning preceded retail confirmation. That ordering gap is the timing asymmetry that matters here. But the buyback signal is only as durable as the cash flow that backs it, and Shell's cash flow is not a single variable. It is a composite of 3 segments with structurally different oil price sensitivities. The consensus assumption embedded in Shell's current price is that a Hormuz ceasefire, which Trump described as near and potentially days away, unwinds the earnings tailwind and therefore unwinds the stock. That assumption misreads Shell's revenue architecture in a way that changes the holding period calculation. Upstream production is the segment most directly correlated to Brent crude. Realized prices move nearly 1-for-1 with the benchmark, and because costs lag, the profit margin expands sharply on the way up and contracts sharply on the way down. A ceasefire that returns Brent toward pre-conflict levels hits upstream hard. That part of the consensus is correct. But Shell's integrated gas division, which includes its position as one of the world's largest LNG traders, is only partially connected to oil prices. LNG contract structures and destination market premiums introduce a pricing layer that does not reset instantly when Brent falls. The downstream segment, refining and retail fuel, can actually benefit from lower oil prices through improved refining margins and stronger demand volumes, creating a partial internal hedge that did not exist at the same scale in prior cycles. The net effect is that Shell's earnings do not fall 1-for-1 with Brent, and the price-to-earnings ratio of 13.87, already below the FTSE 100 average of 16.2, means the market has not yet priced the integrated buffer into the valuation. That gap is what kept Shell generating billions in profit and $26 billion in free cash flow for the full year 2025, even when oil prices were substantially lower than they are now. Counter-signal on this reading: if the ceasefire framework includes Iran resuming oil sales, plus a U.S. sanction grant on Iranian crude during negotiations, the supply increase could be larger and faster than a typical price correction, compressing upstream margins before the LNG and downstream buffers fully absorb the move. The threshold to watch is not whether Brent falls. It is whether Brent falls faster than the pace at which LNG spot premiums and refining margins can widen to offset upstream compression. If that threshold is crossed within the 60-day ceasefire framework reported by Axios, the integrated buffer thesis faces its first real test since Shell restructured its segment mix. The Follow This resolution received 12.7% of shareholder votes at the AGM, down from 20.6% in 2025 and well below the 30.5% peak in 2021, and the surface reading is that climate pressure on Shell is retreating. That reading inverts the relevant signal. The resolution asked Shell to publish a strategy for creating shareholder value specifically under a fossil fuel demand decline scenario, not to commit to a transition, not to set new emissions targets, but to disclose what the business plan looks like if structural demand falls. Shell's board, backed by proxy advisors ISS and Glass Lewis, refused on the grounds that scenario-based disclosure would be damaging and duplicative. The refusal is itself the analytical event. Shell's management is betting that the Iran war's demonstration of fossil fuel indispensability has shifted the political economy of energy disclosure far enough that the 12.7% minority no longer represents a credible governance escalation path. That bet changes the stock's risk structure in a specific and non-obvious way, not because 12.7% threatens a revolt, but because institutional holders who voted for the resolution are now priced into a SHEL thesis that does not include a published demand decline contingency. Mark Van Baal's reminder at the AGM is the checkoff anchor. SHEL cut its dividend 66% in 2020 when oil demand collapsed during the pandemic, not when prices fell gradually, but when demand dropped abruptly. The question the 12.7% vote leaves unresolved is whether the same institutions who repositioned into SHEL on the $3 billion buyback signal hold long enough to face the scenario the board refused to model. The holding period thesis on SHEL therefore bifurcates here. Traders positioned for the Hormuz premium to sustain through a delayed ceasefire have a different exit trigger than institutions weighing whether management's refusal to plan for demand decline creates a governance discount that compounds over a multi-year horizon. Neither group has yet confirmed which frame governs, and that unresolved bifurcation is the monitoring variable that survives long after the Strait of Hormuz reopens. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.